There are rare moments in history when the financial world quietly moves toward a turning point that very few people recognize while it is happening. These moments often begin slowly, hidden beneath everyday news, routine market movements, and the comforting illusion that the current system will continue forever. But beneath the surface, forces begin to build. Forces so powerful that once they reach a critical threshold, they transform the global financial landscape in ways that few imagined possible. Right now, the world is approaching one of those moments. For decades, the global monetary system has operated on confidence. Confidence in paper currencies. Confidence in debt-backed economies. Confidence that central institutions could always stabilize markets whenever instability appeared. This confidence allowed governments to expand spending far beyond what previous generations would have considered sustainable. It allowed financial systems to grow more complex, more leveraged, and more dependent on constant liquidity. But confidence, like any fragile structure, depends on perception. And perception can change faster than anyone expects. Around the world, economic pressures are rising simultaneously. Debt levels are reaching historic highs across both developed and developing economies. Currency values are fluctuating more aggressively as governments struggle to manage inflation, economic slowdowns, and geopolitical uncertainty. Monetary authorities have repeatedly intervened in markets through policies designed to stimulate growth, stabilize banking systems, and maintain liquidity. Yet every intervention has consequences. Each round of money creation expands the supply of currency circulating through the global economy. Each expansion gradually erodes the purchasing power of that currency. And over time, people begin to search for alternatives that cannot be created out of thin air. This is where precious metals enter the conversation. For thousands of years, precious metals have served as stores of value during periods of uncertainty. Long before modern financial systems existed, societies recognized that certain materials possessed qualities that made them uniquely suited for preserving wealth. They were scarce, they were durable, they were universally recognized. Among these materials, one metal has always held a particularly unique position: silver. Unlike many financial assets that derive value primarily from speculation or policy decisions, silver occupies a rare dual role. It is both a monetary metal and an essential industrial material. This dual nature creates a powerful dynamic that few people fully appreciate. On one side, silver acts as a store of value when confidence in financial systems weakens. On the other side, it serves as a critical component in some of the most advanced technologies that power the modern world. Every smartphone, every solar panel, every advanced electronic system relies on silver's unmatched electrical conductivity. Silver plays an irreplaceable role in renewable energy infrastructure, electric vehicles, high-performance electronics, medical technologies, and numerous industrial applications that are rapidly expanding as the global economy transitions toward more technologically advanced systems. This means that demand for silver does not rely solely on investor interest. It is deeply embedded within the physical infrastructure of the modern world. As industries grow, as technology advances, and as the global push toward electrification accelerates, silver demand naturally increases. Every solar installation requires silver, every expansion in electrical infrastructure requires silver, every new generation of advanced electronics relies on silver's unique physical properties, and here lies the first part of the unfolding story. Industrial demand for silver has been increasing steadily, year after year. Entire sectors of the global economy are now dependent on this single metal, but while demand continues to grow, supply has not kept pace. Mining production faces significant challenges. Many of the largest silver deposits have already been discovered and heavily exploited over previous decades. New discoveries are becoming rarer, deeper, and more expensive to develop. Environmental regulations, rising operational costs, and geopolitical risks in key mining regions have made it increasingly difficult to expand production quickly. At the same time, much of the silver that is mined each year is consumed permanently in industrial applications. Unlike gold, which is often stored and recycled, large amounts of silver are used in ways that make recovery economically impractical. Once it is embedded in electronics, solar components, or industrial materials, much of it disappears from the supply chain permanently. This creates a slow but relentless tightening of available supply. The world continues to consume silver at accelerating rates, while new production struggles to keep up. This imbalance between supply and demand does not always appear immediately in price movements. Markets can remain stable for long periods of time, even when underlying conditions are deteriorating. Financial derivatives, paper contracts, and speculative trading often mask the real physical supply constraints that are developing behind the scenes. But eventually, physical reality asserts itself. When physical demand begins to exceed available supply, pressure builds within the market structure. Inventories begin to decline, delivery times increase, premiums on physical metal rise, and slowly the gap between paper market prices and real-world availability begins to widen. This process has happened before. Throughout history, commodity markets have experienced moments when structural shortages suddenly became visible to the broader public. When that realization spreads, price movements can accelerate with astonishing speed. But silver possesses an additional characteristic that amplifies this dynamic even further. The silver market is remarkably small compared to other global financial markets. The total value of all silver produced each year represents only a tiny fraction of the capital that flows through bond markets, equity markets, and currency markets every single day. This means that even a modest shift in investment demand can have an outsized impact on price. If a relatively small percentage of global investors begin allocating funds toward physical silver as a hedge against monetary instability, the available supply can be overwhelmed extremely quickly, and that is where the second major force enters the picture: global monetary instability. Over the past several years, inflation has re-emerged as a dominant economic concern across many countries. The cost of energy, housing, food, and essential goods has risen dramatically in many regions. Governments and central institutions have responded with various policies designed to stabilize economies, but these measures often involve expanding liquidity or maintaining historically elevated debt levels. When currencies lose purchasing power, investors begin searching for assets that cannot be diluted by policy decisions. Real assets become increasingly attractive: land, energy resources, industrial metals, and most importantly, monetary metals. Historically, precious metals have served as a refuge during periods of currency instability. They are not tied to the fiscal policy of any single government. They cannot be printed. They cannot be created through digital entries in financial systems. Their value is anchored in physical scarcity, and silver, because of its relatively low price compared to gold, often becomes the metal of choice for a broader segment of the population during times of financial uncertainty. When individuals begin seeking protection from inflation or currency depreciation, silver becomes accessible. It allows ordinary people to convert paper wealth into a tangible asset that has preserved purchasing power across centuries. But this accessibility also means that silver demand can surge rapidly during moments of widespread economic anxiety. Unlike larger financial markets that can absorb billions of dollars without significant disruption, the silver market reacts quickly when demand accelerates. And history shows that when silver begins moving, it rarely moves slowly. There have been periods when silver prices multiplied several times within relatively short time frames. These surges were not random events. They occurred when multiple forces aligned simultaneously: monetary instability, supply constraints, rising investment demand, and shifts in global economic confidence. When those conditions appear together, the market can enter a phase where prices accelerate dramatically. Today, many of those same conditions are quietly aligning once again. Industrial demand is expanding faster than many analysts anticipated. Renewable energy infrastructure is scaling globally. Advanced technologies are consuming increasing quantities of silver each year. Mining supply is struggling to grow at the same pace. Global debt levels are higher than at any time in modern history, and inflation continues to reshape economic behavior around the world. These forces are building simultaneously. At first, the impact appears gradual. Market prices fluctuate within familiar ranges. Analysts debate short-term trends. Headlines focus on daily movements rather than long-term structural changes. But beneath the surface, the foundation of the silver market is shifting. Inventories that once seemed abundant are slowly being drawn down. Industrial users are securing supply contracts further into the future. Investors are beginning to re-examine the role of tangible assets in a world where financial systems appear increasingly fragile. These developments rarely dominate mainstream financial discussions. Yet history teaches an important lesson. The biggest market transformations often occur when the majority of people are not paying attention. The early stages of major commodity cycles are typically quiet. Only later, when prices begin rising dramatically, does widespread awareness emerge. By that time, the most significant opportunities have often already passed. This is why understanding the structural forces shaping the silver market today is so important. The story is not about daily price fluctuations. It is about a deeper transformation in how the world values physical assets in an era of expanding monetary uncertainty. Silver sits at the intersection of two powerful global trends: technological expansion and monetary instability. On one side, the world is building the infrastructure of the future: energy systems, communication networks, advanced electronics. All of these rely heavily on silver. On the other side, the financial system is navigating unprecedented levels of debt, currency expansion, and geopolitical tension. When these two forces collide, they create a dynamic that has historically led to explosive movements in precious metal markets. But markets rarely announce these moments in advance. They unfold gradually, quietly, until suddenly the shift becomes undeniable. And by the time the broader public realizes what is happening, the market has already begun moving. The window of opportunity closes quickly. Understanding this pattern requires stepping back from daily headlines and examining the larger arc of economic history. Throughout centuries, monetary systems have repeatedly faced moments of stress. When confidence in paper systems weakens, societies naturally gravitate toward assets that possess intrinsic value. Silver has been one of those assets for thousands of years. It has served as money. It has powered industries. It has preserved wealth across generations. And today, in a world where technological demand is accelerating while financial systems face increasing pressure, silver once again stands at the center of a potential historic transformation. The question is no longer whether silver will play a critical role in the future. The real question is how quickly the world will recognize what is already beginning to unfold. And that realization may arrive sooner than most people expect. When markets reach the edge of a major transformation, the signals rarely appear in one single dramatic event. Instead, they emerge as a series of interconnected pressures building beneath the surface of the global economy. Each pressure alone might seem manageable, but when they begin reinforcing each other, they create a chain reaction that can reshape entire financial systems. The silver market today sits directly in the path of such a chain reaction. To understand why, it is necessary to look deeper into the structure of modern financial markets. Over the past several decades, financial systems have become increasingly dependent on paper instruments, derivatives, leverage, and synthetic exposure to assets. These tools allow enormous volumes of trading activity to occur without requiring the immediate transfer of physical goods. In many markets, this structure works efficiently. Traders can hedge risk, institutions can manage liquidity, and investors can gain exposure to commodities without needing to store physical materials. But this structure also creates a potential vulnerability. When the volume of paper claims on an asset grows far larger than the physical supply of that asset, the system becomes dependent on confidence. As long as most participants are willing to settle transactions in cash rather than demand physical delivery, the system functions smoothly. However, if confidence shifts and a significant number of participants begin seeking actual physical possession, the imbalance can quickly become visible. This dynamic has appeared repeatedly in commodity markets throughout history. When the number of claims exceeds the available supply, the market eventually experiences a moment of repricing. Prices must rise high enough to ration demand and attract new supply. In the case of silver, this potential imbalance is particularly significant. Industrial demand consumes enormous quantities each year. At the same time, investment demand can surge quickly when economic conditions deteriorate. Meanwhile, mining supply remains relatively inflexible in the short term. It takes years to discover, finance, permit, and develop new mines. This means that when demand accelerates suddenly, the supply response cannot keep up. The result is a tightening market where available inventory begins disappearing faster than it can be replaced. One of the most important signals in any commodity market is inventory levels. When inventories decline steadily over multiple years, it indicates that consumption is exceeding production. This condition is known as a structural deficit. Structural deficits cannot continue indefinitely without affecting price. Eventually, the market must adjust. Silver has experienced several years where demand has exceeded supply. Industrial growth, technological expansion, and rising investor interest have gradually absorbed large portions of available above-ground inventories. At the same time, many investors who accumulate physical silver tend to hold it for long periods of time. Unlike speculative traders who buy and sell rapidly, long-term holders often remove metal from the circulating supply. This behavior further tightens the market. Every ounce that disappears into long-term storage reduces the amount available to meet future demand. And as inventories shrink, the sensitivity of the market increases. When supply is abundant, large purchases can be absorbed without significant price changes. But when inventories are tight, even moderate increases in demand can trigger powerful upward movements. This phenomenon is sometimes described as a supply squeeze. It occurs when buyers compete for a limited pool of available material. As competition intensifies, prices rise rapidly until some buyers are forced to step aside. But silver's situation is even more complex. Because silver is both an industrial metal and a monetary metal, its demand drivers are not limited to one sector. When economic growth expands industrial demand while financial uncertainty increases investment demand simultaneously, the market experiences pressure from two directions at once. This dual pressure is rare, but when it occurs, it can produce extraordinary price movements. The transition toward renewable energy is one of the most significant industrial transformations of the modern era. Solar power installations are expanding rapidly around the world. Each solar panel contains small amounts of silver, used in conductive components that enable electricity generation. When multiplied across millions of installations, these small quantities become enormous volumes. As countries expand renewable energy infrastructure, the silver required for these systems increases dramatically, and because silver possesses unmatched conductivity, replacing it in many applications is extremely difficult without sacrificing efficiency. At the same time, the global economy continues to digitize and electrify. Advanced electronics, high-performance computing systems, electric vehicles, telecommunications networks, and countless other technologies all depend on silver's unique properties. Every year, new industries emerge that require more silver than previous technologies. This trend represents a long-term structural increase in industrial demand. But industrial demand alone does not explain the full picture. The monetary side of silver demand is equally important. Throughout history, whenever inflation accelerates or currencies weaken, people begin searching for ways to protect purchasing power. Precious metals have served this function for centuries because they are independent of political decisions and monetary policy. When individuals and institutions lose confidence in paper currencies, they often shift a portion of their wealth into tangible assets. Silver becomes especially attractive during these periods because it is more affordable than gold and widely recognized as a store of value. As a result, waves of investment demand can appear suddenly, and because the silver market is relatively small, these waves can push prices dramatically higher in a short period of time. History provides powerful examples of how quickly silver markets can move when conditions align. Periods of monetary instability, combined with supply constraints, have produced some of the most explosive price movements in commodity market history. During those moments, silver did not rise gradually. It accelerated. Prices multiplied within months, as investors rushed to secure physical metal while supplies tightened. What makes the current environment particularly unusual is that several long-term forces are converging simultaneously. Global debt levels are extremely high. Governments around the world rely on borrowing to finance economic activity and social programs. Maintaining stability within such a system often requires ongoing monetary intervention. When economic slowdowns occur, liquidity injections become a common response. These policies can support markets in the short term, but they also expand the supply of currency within the financial system. Over time, expanding currency supply can weaken purchasing power. As people recognize this dynamic, interest in real assets begins to grow. At the same time, geopolitical tensions are increasing across many regions of the world. Trade relationships are shifting, supply chains are being reorganized. Nations are reevaluating strategic resources and critical materials. Silver is increasingly viewed as one of those critical materials. Its role in advanced technology and energy infrastructure makes it strategically important for industrial development. This recognition adds another layer of demand pressure. Countries seeking technological leadership must secure reliable supplies of key materials. Industries building the infrastructure of the future must guarantee access to silver for production. And investors seeking protection from financial uncertainty recognize that silver combines industrial necessity with monetary scarcity. These forces together create a powerful feedback loop. Industrial demand tightens supply. Investment demand accelerates price movements. Higher prices attract attention, and increased attention brings more participants into the market. Eventually, the momentum becomes self-reinforcing. This is how major commodity bull markets develop. They begin quietly, driven by structural fundamentals that most people overlook. Then gradually, the narrative begins spreading through financial communities. Analysts start discussing supply deficits. Investors begin reallocating capital. Media coverage expands, and suddenly the market enters a phase of widespread awareness. By that stage, the price trajectory often changes dramatically. Instead of gradual movements, markets begin experiencing rapid surges, followed by brief consolidations. Each surge attracts new participants who fear missing the opportunity. This psychological dynamic amplifies the underlying supply-demand imbalance. When people believe a resource is becoming scarce, they accelerate purchasing decisions. Waiting no longer feels safe. The fear of missing out replaces hesitation. In markets with limited supply, this shift in psychology can drive prices much higher than traditional valuation models would suggest. Silver has historically exhibited exactly this behavior during major bull cycles. Because the market is relatively small, it does not require enormous capital flows to produce significant price movements. Even a modest reallocation of global investment capital towards silver can overwhelm available supply, and once inventories begin tightening visibly, the narrative can spread rapidly. Investors who once ignored the metal begin reconsidering it. Institutions that previously focused on other assets start analyzing the market more carefully. Individuals who never thought about precious metals suddenly become curious about their role in protecting wealth. This expansion of awareness can transform a niche market into a global phenomenon, but timing is crucial. The early phase of a bull market offers the greatest opportunity because prices have not yet fully adjusted to the new reality. As the cycle progresses, opportunities become more limited. Eventually, when excitement reaches extreme levels, the market enters a phase where prices rise faster than fundamentals alone would justify. That stage often marks the final portion of the cycle. But before reaching that point, there is usually a long period where fundamentals steadily push prices upward as supply struggles to keep pace with demand. Many indicators suggest that silver may be entering such a phase now. Supply growth remains constrained by geological, environmental, and economic factors. Industrial demand continues expanding as technological adoption accelerates. Investment interest is gradually increasing as inflation and monetary instability reshape financial thinking. Each of these trends reinforces the others. And when multiple reinforcing trends appear simultaneously, markets can move in ways that surprise even experienced observers. The concept of silver becoming priceless does not necessarily mean that it will literally lose a measurable price. Rather, it reflects the possibility that its value relative to paper currencies could rise dramatically if confidence in those currencies weakens significantly. If a monetary system experiences severe instability, assets that preserve purchasing power often experience extraordinary appreciation in nominal terms. This phenomenon has appeared repeatedly throughout history during periods of currency devaluation. In such environments, the price of real assets rises not only because demand increases, but also because the measuring unit, the currency itself, loses value. Silver, with its limited supply and universal recognition, becomes one of the assets people turn to when seeking stability. And if industrial demand simultaneously continues consuming large quantities of the metal, the supply available for investment becomes even more restricted. That combination creates the conditions for a powerful repricing event. But perhaps the most important factor in understanding this moment is recognizing how quickly perception can change. For years, many people have viewed silver as a quiet, overlooked asset. It rarely dominates financial headlines. Its price movements often appear modest compared to the dramatic swings seen in technology stocks or cryptocurrency markets. This quiet reputation can persist for long periods, until suddenly it doesn't. Commodity markets have a history of moving slowly for years and then accelerating dramatically within a very short time frame. When the tipping point arrives, the transition from calm to explosive movement can happen faster than anyone anticipates. Those who recognize the structural changes early find themselves positioned ahead of the crowd. Those who waited for confirmation often discover that prices have already moved significantly. This is why understanding long-term fundamentals matters more than reacting to short-term volatility. The story unfolding in the silver market is not about daily price fluctuations. It is about a deeper transformation in how the global economy values scarce physical resources in an era defined by technological expansion and monetary uncertainty. When supply constraints intersect with rising demand and shifting financial psychology, markets can enter historic cycles. And silver, perhaps more than any other metal, sits at the center of this convergence. History repeatedly shows that the greatest financial opportunities appear quietly before the world recognizes their significance. Silver today stands at the intersection of powerful forces: growing industrial demand, tightening supply, and rising global monetary uncertainty. These forces are not temporary trends, they are structural changes that could reshape the value of this metal for years to come. Whether the transformation unfolds gradually or accelerates suddenly, one reality is becoming increasingly clear: the window to recognize silver's true importance may not remain open forever. Those who understand the moment early often find themselves ahead of history rather than chasing it after the fact.